I'm putting it all on the line. I have been for a while now, because right now, if you look around, it seems like 95% of people on X, in the YouTube comments, even on this video, many people are very bearish right now. Markets are down. Things are not looking good at this very moment. And here I am still posting bullish content. And there's been like kind of this progression for me as an analyst in this market, studying a lot of different data. That's why the style of this video is going to be different. But I know it's either going to look like I failed miserably in front of everyone here as I chase this data every day and present it to you, or it's going to be one of those great plays that we can talk about later. But what I want to do is I want to dive in and I want to show you exactly why I'm staying bullish right now, even in this moment of fear. And it's data backed. You can disagree, and I respect that. But I want to present to you why I'm still a macro bull, especially right now. We're going to walk through the real macro data. It's not hitting the headlines, but it absolutely is setting the stage. So by the time this video is over, you'll understand why this moment in the macro cycle might be the most important, significant moment, especially when compared to something like a single rate cut event for the month of December, and why the turn may already be underway, happening right now beneath the surface. So hit the subscribe and like on the way in. And if you're not in our intelligence system, click the link below, get set up with a trial, and hop into our risk models. So we all need to realize exactly where we are at this moment of the cycle. And this is not based on 4-year cycle theory. There are way bigger things in play. This is the long-term PMI chart back to the 1940s. This chart goes back nearly a century, and it's the PMI. It's the Purchasing Managers Index. It essentially is the economy's activity meter, heavily influenced by new orders and production. So basically, when PMI is above 50, the economy is expanding. Below 50, it's contracting. And right now, we're still in contraction after years of contraction. Manufacturing PMI has been under 50 for a pretty long time. In fact, depending on the series that you're looking at, it's been contracting for a consecutive 8 months. And some analysts describe 34 of the last 36 months as either contractionary or stagnating. And this isn't like just like some small pullback. It's one of the longest and tightest contraction regimes of the modern era. Look at the chart. But the contraction alone doesn't tell the entire story and everything that's going on right now. And so what matters is what comes next and what historically follows long contractions like this one that we have on the screen. And so this brings us to the core of today's analysis. There is somewhat an obsession with rate cuts, specifically right now in the short term, December rate cuts. What's Powell going to do? Right now, the odds are falling that he's going to cut rates. Markets are fixated on this. Rate cut probabilities have been falling, and Powell's kind of signaling some caution in that regard. But we have to take this into play. There have been data disruptions from the shutdown, and that adds a lot of uncertainty to markets in general, and uncertainty into what Jerome Powell is actually going to do. Many investors are just worried. If Powell doesn't cut interest rates, the cycle is not going to turn. It's all going back down. That's kind of the general short-term outlook, the sentiment. But that assumption comes from a misunderstanding of how liquidity actually moves through the financial system. And this has everything to do with crypto. Rate cuts are just one mechanism, but they're absolutely not the only mechanism. And when it comes to these mechanisms, now is the exact time on the macro to understand them. So to see the full picture, we need to step into like the plumbing of all of this financial stuff that's going on right now. And I want to make a note. This isn't just my observation. There are other macro analysts that are noticing the same shift that is happening right now under the surface. Here's one analyst, Mel Madison on X. He says, "We have had one of the driest periods for fiscal liquidity in months, if not years. The fact that markets and BTC are still up where they are is incredible." So that's another way of saying crypto has been resilient through contraction, and we've seen it. Years of contraction. This is exactly why you hear people say it's like we've been in a bear market this entire time, but it's weird because if you go look at all of the charts, mostly they're higher highs and higher lows. It's not been just lower lows and lower highs for years. But Mel also pointed something else that's very important. The floodgates are now being opened. So think about this. When you combine the fiscal side, the TGA flows, QT ending, and the shutdown impact, you get the early signs of liquidity returning to the system. And he even reminded everyone of the accounting identity. Fiscal deficits equals private sector surpluses. In plain English, when the government spends, the private economy benefits. And then he closed with a line that really captures what liquidity transmission looks like. As liquidity comes in like a full moon high tide, price action moves toward the self-evident space on every beach where the ocean forces its way onto the shore. That's liquidity transmission. Slow at first and then all at once. Now let's really get into this. Quantitative tightening coming to an end December 1st. This is the Federal Reserve's balance sheet that you see on the screen right here. For the last 3 years, The Fed has been reducing it through quantitative tightening. QT is simple. It drains liquidity from the system. Absolutely not good for crypto or any risk on asset. It reduces bank reserves, tightens financial conditions, and acts as a sustained headwind. On December 1st, QT ends. That means reserve drainage stops, balance sheet shrinkage stops, the liquidity vacuum stops pulling money out of the system, and this is not some small little headline or some small little narrative or detail. QT ending is historically associated with a major macro shift because it stops the constant flow of pressure leaving the system. This doesn't immediately inject liquidity. Like, we're not going to pump on December 2nd because of this, but it simply removes this macro headwind. And in the macro, going from constant tightening for years to neutral, that is a major shift in the macro. So now I want to look at the Treasury General Account, the TGA. This is basically the US government's checking account at the Federal Reserve. When the government spends from the TGA, those dollars move directly into the real economy. And right now, nearly $1 trillion is staged to be released as the government is reopening. This is one of the most under-discussed liquidity forces in the entire market. It's being discussed that the government's reopening. That's a good thing, but it's the liquidity on the short term that stems from this. Shutdown ending means federal contractors get paid, delayed projects resume, invoices clear, ending flows into supply chains. This is real economy liquidity. It's not just financial system liquidity. So historically, TGA drawdowns correlate strongly with increases in orders, production, and PMI recovery. Now we need to start putting things together and talk about liquidity transmission and the mechanism behind that. Liquidity transmission is a process where liquidity becomes real economic activity, which becomes PMI expansion, and that becomes a business cycle turn. And this is what I've been anticipating on the macro zoomed out, even amidst the short-term and midterm volatility. It doesn't happen instantly. Flows can shift overnight, but orders, production, and PMI can take weeks or months to reflect that. This is why timing liquidity transmission is difficult. Liquidity turns fast, business cycles, they turn slow. But that turn does begin behind the scenes, not at the Fed's press conference, not in the headlines. So when you combine quantitative tightening ending, this is a long-term liquidity reversal, and TGA spending returning, that is a short-term liquidity shock, you get the early conditions for a business cycle expansion, even without a December rate cut. This is why the December narrative, I think, is a distraction. The real macro signals, the ones that historically precede PMI inflections, are already lining up. I do not think most people are paying attention. Contraction has been deep and long. Liquidity decline is ending. Government spending is about to resume, and liquidity transmission is set to begin. These are the moments that often mark the beginning, not the middle, of a new business cycle expansion. And in risk assets, especially crypto, expansions are where you get the strongest, most persistent multi-month rallies. So here's my takeaway that I want to present to you. A December rate cut would help. It would be bullish. It would be a nice headline, but it's not required for the cycle to turn. Liquidity is already shifting. The plumbing and everything going on behind the surface is aligning. And historically, these are the exact conditions where expansion begins. So what I am doing is I am staying macro aware. I'm trying to stay patient, and I'm trying to really understand the bigger picture that I think a lot of people are completely missing right now. I hope this kind of explains why I am just staying macro bullish right now. I'm not even discussing how bullish the fundamentals of crypto are. I'm not discussing altcoin ETFs, pro-crypto legislation, and what the administration is doing, what the SEC is doing for crypto right now. I'm not discussing any of that. This is a macroeconomic picture of what is happening right now and what I think is getting ready to happen. For me, the risk, as I say, is in being bearish right now. The risk is not having exposure to these markets right now. The risk for me is not being invested in crypto on the macro right now. So let me know your thoughts in the comments below. If you're not a subscriber, please subscribe. If you found this content valuable, please give it a like. I'll see you in the next video. God bless.